Hi guys, we are from Group 2, consists of Valia Zakira Utami, Nadia Alia Fitri, and me, Yasmin Luxia. In these opportunities, we will explain the topic is financial reporting and analysis. This is the table of contents that we will talk. There are reporting environment, nature and purpose of accounting, accruals, cornerstone of accounting, the concept of income, fair value accounting, and introduction to accounting analysis. Okay, the first subtopic that we will talk is about reporting environment. In reporting environment itself, there are the statutory report that didn't get too much attention, like financial report. So in this explanation, in this PPT, we will talk more about the statutory report. Statutory report is the obligatory submissions of financial and non-financial information to a government or concerned agencies. So mostly statutory report is important for a company and must make a public by law, especially its financial report. So in statutory financial report, there are three categories that have statutory report. First, in financial statement. The statutory equivalent to the annual report is the Form 10K, which public companies must file with the SEC, Security Exchange Commission. When analyzing quarterly information, we need to recognize two crucial factors. First is seasonality. There are year-end adjustment. Year-end adjustment itself is companies often make adjustment, for example, inventory write-off in financial quarter. Many of these adjustments relate to the entire year. This renders quarterly information less reliable for analysis purposes. And then there are earning announcements. And earning announcements provide key summary information about company position and performance for both quarterly and annual report. Recently, companies have focused investors' attention on pro forma earnings in their earnings announcement. But investors should not blindly eliminate the information contained in non-recurring and non-core items by focusing solely on the pro forma earnings, because in pro forma earnings there are some information that not complete. And then a systematic definition of operating earnings and a standard income statement format might offer helpful clarification, but it should not be a substitute for the due diligence and true examination of the footnotes that constitute comprehensive financial statement analysis. So this is the other statutory report. There are Form 10K, Form 10Q, there are Form 20F, and there are Form 8K, and there are Regulation 14A that you can read by yourself. And then we will talk about the factors affecting the statutory financial report. First, there are GAAP. GAAP is the general accepted accounting principle that under integrity of the accounting system and the financial records that make up financial statement. And then there are monitoring and enforcement mechanism. These factors ensure the reliability and integrity of financial report. The one that usually monitoring and enforce that do this uh, these activities is auditor, corporate governance, and security and exchange commissions. And then there are alternative information sources that is from economy, industry, and company news. It could be affect statutory financial report, and there are voluntary disclosures and information intermediaries from analysts. So we will talk about the nature and purpose of financial accounting. The nature and purpose of financial accounting is talk about what is the thing that should be included in the financial accounting, so that financial accounting can be run well and can achieve the purpose that companies want. First is desirable qualities of accounting information. The accounting information itself should be relevant. Relevance is related with the time when we make it. And then reliability. Reliability, it's mean the information must be very verifiable, representationally factful, and neutral. And then there are comparability. The accounting information should be comparable to other accounting information. And then there are important principles of accounting. There are accrual accounting, historical cost and fair value, and materiality conservatism. Maybe it's a little bit strange for you guys to about the conservatism. Conservatism involves reporting the least optimistic view when faced the uncertainty in measurement. So that is the definition of conservatism. And then there are relevance and limitation of accounting. First, relevant and of financial accounting information remains the only relevant and reliable system for recording, classifying, and summarizing business activities. And then there are limitation of financial statement information. It should be time the limit the limitation of financial statement information is timeliness. It means the financial statement are prepared as often as every quarter and are typically released from 3 to 6 weeks after the quarter end. It's not long. It's not up. It means that the financial statement information is timeliness. That financial statement information has just required in the that period when the information can be used, and the information can be used for the old period because there are always new updates about the information. So that's why this is timeliness. And then there are frequency of statement financial statement information. Sometimes it's not complete because financial statements are usually prepared periodically, typically each quarter. And then there are forward looking. This forward-looking is alternative information sources, particularly analysts, report, and forecast, use much forward-looking information. The next slide will be explained by Nadia.
Now I will continue this presentation. The next topic is about accruals, cornerstone of accounting. Accrual accounting framework aims to inform users about the consequence of business activities for a company's future cash flow as soon as possible with a reasonable level of certainty. Accruals are the sum of accounting adjustments that make net income different from net cash flow. The most common meaning of accrual is accounting adjustment that convert operating cash flow to net income. So the net income formula is equals to operating cash flow plus accruals. Next is accrual accounting, reduce timing and matching problems. The timing problems is referred to cash flow that do not occur contemporaneously with the business activities yielding the cash flow. Otherwise, matching problems is referred to cash inflows and cash outflows that occur from a business activity but are not matched in time with each other. Next is accrual process. In the accrual process, there are two fundamental principles. The first is revenue recognition and the second expense matching. In revenues recognition, revenues are recognized when both earned and either realized or realizable. The second fundamental is expense matching. Accrual accounting dictates that expenses are matched with their corresponding revenues. This matching process is different for two major types of expenses, such as product cost and period cost. Next, we're going to talk about the types of accrual. There are two types of accrual accounting. The first one is short-term accruals, and the second is long-term accruals. In short-term accruals arise primarily from inventories and credit transactions that give rise to all types of receivable and payables. Otherwise, long-term is arise from capitalization. Next is relevance and limitation of accrual accounting. So there, as I said before, there are two types of accrual accounting. In the short term, is improved to relevance of accounting by helping record revenues when earned and expenses when incurred. Relevance in long-term accrual in providing relevant information about a company's financial performance, financial condition, and for predicting future cash flow are the superiority of long-term accruals. The next subtopic is concept of income. Now I would like to talk about myth and truth about accrual and cash flow. There are some of incorrect statements about accrual and cash flow. The first one is because company value depends on future cash flow, only current cash flow are relevant for valuation. The second statement is all cash flow are value relevant. The third, all accrual accounting adjustment are value irrelevant. The next is cash flow cannot be manipulated. All income is manipulated. And the last wrong statement is it is impossible to consistently manage income upward in the long run. So there are also the true statement. The first statement is accrual accounting income is more relevant than cash flow. This is the true statement. The second statement is cash flow are more reliable than accruals. Next is accrual accounting number are subject to accounting distortion. And the last statement is company value can be determined by using accrual accounting numbers. Next is economic concept of income. There are three types of economic concept of income. The first type is economic income, is to measure change in shareholder value. Economic income also useful when the objective of analysis is determining the exact return to the shareholder for the period. The second concept is permanent income. In this permanent income reflects a long-term focus, and the concept in permanent income similar to sustainable earning power, which is an important concept for both equity valuation and credit analysis. And the last concept is operating income. In operating income, an important concept in valuation, it is important arises from the goal of corporate finance to separate the operating activities of business from the financing or treasury activities. Next is accounting concept of income. Based on the concept of accrual account. Accounting concept of income is based on the concept of accrual accounting. While accounting income does reflect aspect of both economic income and permanent income, it does not purport to measure either income concept. Next is accounting income versus economic income. There are several differences in accounting income and economic income, such as the first is alternative income concept, historical cost, transaction basis, conservatism, and earnings management. Next is permanent, transitory, and value irrelevant components. In permanent component has characteristic identical to the economic concept of permanent income. The second is transitory component is not expected to recur. It is a one-time event. The concept of economic income includes both permanent and transitory components. And the third is value irrelevant component is arise from the imperfections in accounting. The next subtopic will be explained by Valia.
Hello everyone, my name is Valia Zakira Utami. I'm going to explain my part in this presentation. 5. Fair value accounting. Under the fair value accounting model, asset and liability values are determined on the basis of their fair values on the measurement date. Contrasting historical cost and fair value models. First, transaction versus current valuation. Second, cost versus market base. And the third, alternative income approaches. Considerations in measuring fair value. SFAS 1570 defines fair value as exchange price, that is, the price that will be received from selling an asset in an orderly transaction between market participants on the measurement date. Valuation techniques consist of market approach, income approach, and cost approach. Analysis implications. Major advantages of fair value. 1. Reflects current information. 2. Consistent measurement criteria. 3. Comparability. 4. Non-conservative bias. And 5. More useful for equity analysis. Major disadvantages of fair value accounting. 1. Lower objectivity. 2. Susceptibility to manipulation. 3. Use of level 3 inputs. 4. Lack of conservatism. And 5. Excessive income volatility. Implications for analysis. 1. Focus on the balance sheet. 2. Restating income. 3. Analyzing use of inputs and analyzing financial liabilities. Current status of fair value adaptations. Now is applicable primarily to assets and liabilities that can be broadly termed as financial in nature. 6. Introduction to accounting analysis. This is the process of evaluating the extent to which a company's accounting numbers reflect economic reality. The need for accounting analysis because of two reasons. First, accurate accounting improves upon cash accounting by reflecting business activities in a more timely manner. But this yields some accounting distortions that need to be identified and adjusted so accounting information better reflects business activities. And the second, financial statements are prepared for a diverse set of users and information needs. Accounting distortions consists of accounting standards, estimation errors, reliability versus relevance, and earnings management. Earnings management is purposeful intervention by management in the earnings determination process, usually to satisfy selfish objectives. Earnings management strategies consist of increasing income, big bet, and income smoothing. Motivations for earnings management consist of contracting incentive, stock price effects, and other incentives. Mechanics of earnings management consist of income shifting and classificatory earnings management. Analysis implications of earnings management. 1. Incentives for earnings management. 2. Management reputation and history. 3. Consistent pattern. And 4. Earnings management opportunities. Process of accounting analysis. Steps in evaluating earnings quality. First, identify and assess key accounting policies. 2. Evaluate extent of accounting flexibility. 3. Determine the reporting strategy. And 4. Identify and assess red flags. Adjusting financial statements. 1. Capitalization of long-term operating leases with adjustments to both the balance sheet and income statement. 2. Recognition of ISO expense for income determination. 3. Adjustments for one-time charges such as asset impairments and restructuring costs. And recognition of the economic status of pension and other retirement benefit plans on the balance sheet. And last, removal of the effects of selected deferred income tax liabilities and assets from the balance sheet. That's all of our presentation. Thank you for attention.